Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
All right, let's get right into it. This is our U.S. market analysis for Wednesday, April 15th, 2026.
And just so we're all on the same page, this video presents a direct informational narration of the source document. Okay, and a quick but really important notice first. This is for informational purposes only, and it does not constitute investment advice. Investing involves significant risk, including the potential loss of principal. Past performance is not indicative of future results. And of course, the information in here can be time sensitive. So here's what we've got on the agenda. We're going to break this down into 6 sections. We'll kick things off with the broad market breakouts and geopolitics. Then we'll dive into fund flows and market dynamics. After that, we'll deconstruct the logic behind this rally, and then a really interesting one, a change to the pattern day trader rule. We'll follow that with some technicals and key company news, and finally wrap up with the forward-looking risk outlook. All right, section 1. Let's start with the big picture, the broad breakouts and the geopolitical landscape, giving an overview of the session's really strong upside momentum and its core drivers.
Wow, the market really showed some incredible strength. The S&P 500 and the NASDAQ 100 both closed at record highs. And get this, the NASDAQ 100 is now on an 11-session winning streak. That's its longest since all the way back in December of 2019. It's as if the recent US-Iran conflict never even happened. The market has fully retraced all of those losses.
So, what's behind this massive move? Well, it looks like the market is pricing in a peace dividend, right? But here's the catch, and it's a big one. Iran has explicitly stressed that this whole move depends on whether the United States meets its specific demands. So, while the market's optimistic, everything is still very, very conditional.
Okay, so that brings us to section 2. With that geopolitical context in mind, where's the money actually flowing? Let's analyze capital rotation and the behavior of institutional versus retail investors. It's pretty clear that market balls are concentrating their buying in 2 main areas, high beta megacaps and the software sector. Look at Tesla. It had a huge 7% gain, really leading this breakout. And NVIDIA, the expanding volume there just confirms that there's deep institutional participation. The software sector, tracked by IGV, and Microsoft along with it, also advanced by roughly 4%.
But here's the core logic, and this is really key. The software sector breakout, it wasn't really driven by fundamentals. It was driven more by short covering. You had a lot of people betting against these stocks, and as the price went up, they were forced to buy back their shares, which just propelled the rally even higher. And this really shows the split between the institutional side and the retail side right now. On the institutional side, the hedge funds, their net exposure is only 51%, so they're lagging the index. This has created a classic panic buying dynamic where they're forced to chase the market and buy liquidity at premium levels. But on the retail side, well, their sentiment was just ignited by the technical breakout. You can see it in the data. Robinhood's trading volume jumped to 4th in the entire market. Those inflows just show you that we're in a sentiment-driven, accelerated phase. Okay, moving on to section 3. Deconstructing the rally's logic. So how do we put all these pieces together? Let's do a 4-dimensional breakdown of the forces that were behind this week's big market move. You can really think of this as a 4-step process. Step 1, the spark, was geopolitics. Step 2, the fuel, came from CTA funds. Step 3 was the engine, which was the hedge funds being forced to buy. And finally, step 4, the amplifier, was the rush of retail participation. And here's the bottom line from the analysis, and I'm quoting here. Because this rally is based on missing positioning rather than upward earnings revisions, the current market has a clear buy the expectation profile. So what does that mean? It means we're in a buy the rumor phase, and we need to be very alert for a potential sell the facts situation. All right, let's shift gears to section 4, and this is a big one. We're talking about the pattern day trader rule change. Let's examine the impact of the SEC and FINRA removing those PDT restrictions. So let's look at a side-by-side comparison. Under the old rule, established way back in 2001, you were identified as a pattern day trader if you made at least 4 day trades in 5 trading days, and that came with a minimum asset requirement of $25,000. Well, under the new rule, approved in April 2026, they are removing that PDT-specific identification and removing the $25,000 threshold. The risk control mechanism is also changing. It used to be a mandatory trading interruption, now it's shifting to an intraday margin matching system. The one thing that's staying is the minimum account equity, which remains at the $2,000 base threshold.
So why does this matter so much? We'll look at the average account sizes for different brokers. For Robinhood, it's about $24,000. Compare that to Interactive Brokers at $177,000 or Charles Schwab at $309,000. Robinhood's average is sitting just below that old $25,000 PDT threshold. So this rule change is a massive deal for them and their users. It could really act as a volatility amplifier for the whole market.
All right, on to Section 5, Technicals and Key Company News. We're going to assess the current cycle conditions and talk about some significant corporate developments. Let's talk about the technicals. The number to focus on is 89. That's where the NASDAQ 100's RSI is right now. To put that in perspective, just 2 weeks ago it was at 18, which is considered oversold. Now it's at 89, extremely overbought. This really suggests we're in a pretty unstable melt-up phase. Now for some key company developments. First up, Tesla. Musk has confirmed that their AI5 chip has successfully taped out. That's a huge step. But from a trading perspective, that $420 to $465 zone is a very, very strong resistance cluster. Next, ASML. The feedback after their earnings report was stable, and we're told a full valuation update report is going to be published this Friday. And that brings us to our final section, number 6, the forward-looking risk outlook. Here, we're going to highlight the geopolitical negotiations and the building pressure for a regime shift. You know, the market is really facing a sharp transition. We've been in this sentiment-driven trading phase, but now we're moving toward needing fundamental confirmation. And the key variable, the one thing that everything hinges on, is the US-Iran negotiations. So that raises the big question, right? What happens if the negotiations fail? Well, the answer is a potential regime shift, back to pricing in wartime conditions. And this is the final thought to leave you with, straight from the source document. The positive catalyst from buying expectations has been fully priced in. Remain alert to the risk that geopolitical negotiations go off track and trigger an immediate reversal. Basically, all the optimism is already in the price. So we have to stay alert because if these talks fall apart, the reversal could be swift and immediate.